everyone. About myself, I'm an IT employee working in one of the big four organization. I'm basically a part-time option seller and an investor. I do hedge my investing positions. So the primarily objective of this channel is to educate people about the concepts of hedging, option selling, and their strategies from the basics. So if you watch all my videos, even a person who has a zero understanding of the derivative market should be able to trade in the derivative market with confidence. That's our primary objective. So before we begin, viewers should have a basic understanding of the stock market, such as what the Nifty index is all about, what is the bank Nifty index, and how the price movement affects the derivative market. So you should definitely know the basics of the stock market. Then only you can enter the derivatives market. So today let's see what exactly the derivative market is all about. So derivative. So I don't want to give the definition of the meaning or the word derivative. So let's quickly jump into the topic with a basic example. So let's take an example of milk and paneer here. So we make paneer with the milk as an ingredient. So here milk is basically an underlying ingredient and paneer is actually a derivative of milk. So whenever the demand for milk increases, obviously the price will also increase. So whenever the price of milk increases, so does the price of its derivative, which is basically a paneer here. So here the underlying is a milk and the derivative is a paneer. So likewise, in terms of stock market, we have Nifty Futures, Nifty Options. So basically, Nifty Futures and Nifty Options is a derivative of Nifty 50. So whenever the underlying, so Nifty 50 is basically underlying for Nifty Futures or Nifty Options. So whenever underlying price rises or falls, the derivative will also fluctuate. So that's all the derivative is all about. So basically, the derivatives, we'll see what are the different types of derivatives in our upcoming slides. So what is a derivative market? Why the derivative market? So derivative markets, if you see the popularity of the derivatives, you can see like by the turnover in the derivative segments compared to the cash segment. Derivative segment here I'm referring to options and futures, whereas the cash segment is referring to you're going and buying a normal stock. So that is a cash segment. So if you see why do we go for derivatives? So there are basically two main purposes. One is hedging and another is speculation. So what exactly hedging is all about? This is a strategy that tries to limit risks in financial assets. For example, insurance. So I would say hedging is an insurance of investing. For example, if you buy a sports car, just because the car goes too fast, so your chances of meeting with an accident are higher. So you are buying an insurance to hedge the risk, as the insurance company will take care of you if any unexpected things happen. So likewise, there are many ways to hedge your positions, to hedge our positions in the stock market. So we'll discuss all our hedging techniques in our upcoming videos. And so second thing is speculation. So speculation involves like trading a financial instrument in expectation of significant returns. So it's basically a kind of like trying to bet on something. So the main motive is to take maximum advantages of fluctuations in the market. For example, day trading. Assume you're buying a TCS stock for 3,000 rupees, assuming it may go up to 3,050. It's a kind of a speculation. You are expecting the market to go up, and then you are booking the profits and coming out of the market. So 99% of people do only speculation in the stock market. But what advantage does the derivative market gonna give in terms of speculation? So those things we'll discuss in our next video on futures and options. Uh, let's see the edging with an example with respect to the stock market. So I'll explain with you a basic example. So for the edging, so let's see you bought a Reliance shares trading at rupees 2,500, and you bought 100 shares, which is almost equal to 2.5 lakhs worth of Reliance stocks you're having. Assuming your market is crashing tomorrow, and assuming your market is going down, there is high chance that your stock will also go down. So in that case, what we are doing is like we are kind of insuring our position. We are kind of insuring for 2.5 lakhs. So what we are doing is like we are buying a put option here for 2,000 rupees, and we are collecting a premium of 3 rupees. So there will be a lot of confusion what exactly buying a put option. So those things you will be able to understand at the with the upcoming videos. So let's assume with an example. So we are buying an insurance for 300 rupees. For example, you have a car and then you bought a car for around 10 lakh rupees, and every year you are paying a premium of 25,000 rupees to an insurance company. Why exactly we are paying that 25,000 rupees to insurance company? That's because, like, if any unexpected happens, if you met with an accident, the insurance company will pay the money to the people who met with an accident. So the insurance company will pay them instead of you are paying from your pocket. Assume that the other person is expecting 2 lakh rupees, but the insurance company will give them. You're only 25,000 rupees you're paying at the end of the year. Assume if there no unexpected things happens, so what will happen is like that 300 rupees insurance company will keep that 300 rupees. So same way we are giving and paying an insurance of 300 rupees. So assume if market crashes in 1 month and Reliance goes to 1500 rupees, let's see how much is our loss with hedging and without hedging. So without hedging, if you see, you bought a stock of 2500 rupees. Now it gone to 1500 rupees. Here 1000 rupees per stock is a loss here into number of shares you bought. So around 1 lakh rupees of loss in case if Reliance drops from 2500 to 1500. But with hedging, what is happening? Let's see. So here if you see 2500, 1500, so 1 lakh rupees is your loss, but this 50,000 rupees insurance will pay you. Why? Because you are paid an insurance money to the broker, saying that if it goes below 2000 rupees, they'll have to cover. So in that case, if it goes below 2000 rupees minus current price 1500 rupees, so 5000 rupees is your loss, which insurance company will pay you. So that 550,000 rupees they are giving you. So your loss is limited here. If you see, your loss is limited to only 50,000 with hedging. But without hedging, your loss is 1 lakh rupees. That's an advantage of hedging here. Uh, let's go to the next topic. Types of derivative markets. So we have two types of derivatives: OTC derivative market and exchange traded derivative market. But some four major types are options, forwards, futures, and swaps. As far as the stock market is concerned, forwards and swaps don't form a part of trading, so let's skip that. But we can trade in futures and options. Let's try to understand futures and options more thoroughly in our upcoming videos. I can understand the topic is very boring, but just like that, we can't directly pitch into the options of futures without understanding what a derivative market is all about. So, in our next video, we will learn what futures and options are. Please do like and subscribe to our channel if you like our content. If you have any questions or clarification, please do write us at madanraveen@yahoo.com.